Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. I'll be reporting flows for the week ended Wednesday, October 24th, 2018. I think many people will be surprised to see that we only had about $298 million in outflows. Second consecutive week we've seen outflows from the conventional fund business. But that is kind of a story that we'll go into a little bit later when we get the macro group details. You'll kind of see how this panned out. But the reason we think that these outflows occurred and maybe why there was kind of a mixed message in there is we have had some concern in the market. First of all, with China. Trade relations with the United States and seeing some additional drags. There's been threats of even a third round of tariffs being applied. Basically, we've seen later earnings than we thought we had. Again, it could be related to exports. Again, they beat expectations in most cases, but maybe forward guidance has not been as good. And also, we're very concerned about the Federal Reserve Board raising interest rates. They've said they were going to do it. They've been saying they were going to do it for years, but for some reason the market is taking a different stance and being shocked by this. And last, of course, and not least, is the upcoming midterm elections. And a lot of people are concerned about the uncertainty. So again, we saw minor outflows, and we had a pretty big meltdown. Most of that's going to actually have turned out to be a benefit to money market funds. We'll see here in our next slide. Basically, as we turn to our macro groups, that equity funds saw outflows about $3.8 billion this week. Taxable bond funds lost about $2.5 billion. Muni bond funds lost about $470 million. And as I was saying, money market funds took in the only net inflows, $6.4 billion as investors basically headed for the sidelines and basically are sitting pat until they understand what's going on, both in the third quarter earnings season as well as the other issues that are coming up that they just need to have a little bit more development, a little bit more news on so that they can understand how the market is rolling. Let's go ahead and take a look at the macro groups and kind of play-by-play. Let's take a first look at equity funds. Equity funds saw basically a $3.8 billion inflows, 18th consecutive week they've taken in or handed back money. But really what I was telling you about, the big losses, one of the bigger losses out there was the Russell 2000, and that was about 7.5%. But overall, if we take all the equities, put them together for the weekly basis, we lost about 5.67%. That's really quite large. And it's the third week in four they've seen negative performance. If we take this out and break it down to domestic versus non-domestic, domestic equity funds lost about $1.7 billion. 23rd consecutive week they've lost money, and they had a 5.95% loss as far as returns go. And non-domestic equity funds lost about $2.1 billion. Fifth consecutive week they've seen outflows. And the third week in four they've also had negative returns, this time to the tune about 5.06%. If we take a deeper dive and understand what classifications got hit the worst, we see that large cap funds once again lost the biggest share of money, about $1.7 billion. And we see international equity funds that lost about the same, about $1.7 billion. Well, let's go ahead and turn our attention now to the equity ETF side to see what happened in that group. For the 6 week and 7, we've seen they had net inflows, this time to tune about $8 billion. And it's a little surprising. SPY, Spider S&P 500, took in about $3.1 billion. But when I told you a little bit earlier, the iShares Russell 2000 actually took in about $1.2 billion, but the Russell 2000 had the largest negative return for the week of the broad-based indices we follow, about 7.5%. So either they were buying on the dip, which is very possible, or perhaps they were creating inventory for short positions. Anyways, if we start taking a look at the downside areas of this group, we see that the consumer discretionary select sector spider funds actually lost money, about $529 million, and the iShares U.S. real estate ETF lost about $261 million. Not a lot to write home about there. Let's turn our attentions now to the fixed income side of the universe. Basically, fixed income funds for the fourth consecutive week saw outflows $2.5 billion this week. Second week in three that they've had negative performance, this time to the tune of 0.96% as far as losses go. Corporate investment grade debt funds actually took in money, about $209 million, and government treasury mortgage funds took in about $20 million. That was the only plus side as far as inflows go. Outflows, we saw high yield funds hand back about $1.9 billion, and flexible income funds lost about $312 million. Let's go ahead and turn our attention to the ETF side of the fixed income universe and see what happened there. The fixed income ETFs lost about $2 billion this week. It's the second week in 3 that they've seen outflows. JP Morgan Ultra Short Income Fund took in about $506 million. iShares 1 to 3 year Treasury Bond ETF took in about $249 billion. And at the bottom side of this graph, we can basically see that iShares iBox U.S. dollar high yield corporate ETFs lost about 947, and then we see that the corporate, non-high yield, but the corporate investment grade also had losses as well. Let's turn our attention now to the muni side of the business, and muni bond funds saw outflows about $469 million. 5th consecutive week they've seen outflows. 2nd consecutive week though they've seen plus side returns, this time to the tune of about 0.11%. If we break this down into kind of smaller groups, intermediate and municipal debt funds lost about 182, and high yield municipal debt funds lost about $119 million. And on the ETF side, muni bond funds actually handed about $25 million, just a very, very small amount. Well, that brings us to our last macro group, and it'll be the money market fund universe. And as I told you, is kind of the only bright side of the investment universe for this week. We saw for the second week in 3 that they took in net new money, this time to the tune of about $6.4 billion. Taxable money market funds took in $6.1 billion. And if we break that down, we see institutional money market funds took in about 5.7, and retail money market funds took in about $422 million. And on the tax exempt side, they took in about $328 million. Well, that's it for this week. But we had some news come out today. Third quarter GDP earning came in about 3.5%, beat analysts' expectations of 3.3%. But we're seeing in the headlines of the media that's a dour situation that we only have 3.3%. But actually, I think that people are going to wake up and say, hey, that's really good. It's above 3%. It's not in the 4.2, 4.3 that we saw for the prior quarter, but it's still up, still looking pretty strong. But we're going to have to contend with the news that brought out today and yesterday that Amazon and Google third quarter earnings actually came in and disappointed slightly, and most of that was due to forward-looking statements as well. So we'll have to keep an eye on that. If I haven't done a deep enough dive for you, you can go to our site at www.lipperusfundflows.com or join us next week when one of our analysts will talk about the flows trends of the week. Thanks for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.